All right, we are live. Hi, everyone. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined, as always, by our senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob.
Hello, Katie. Good talking to you.
Yeah, you too. I heard you've been doing some traveling recently.
Well, I had to go to Las Vegas for a wedding last week, and I went to see U2 at the Sphere. This new event place that just opened a couple of weeks ago, so we were one of the first people to go. And it's quite an amazing experience. The star of the show is not U2. The star is the building. It is not built like a conventional music venue that usually they're typically box-like or rectangular, and this is not. It's shaped like an egg. It literally is like an egg. So my impulse, being an old guy going to rock concerts for 50 years, is you want to be as close to the band as you can. So I got lower level, 30 rows back, and there's a part in the middle where people can stand, a small part in front of the band. And that was a mistake, because what happens in this thing shaped like an egg is you're here, the band's here, and the backdrop unfolds behind you all the way up to the ceiling and behind you. It's an enormous moving backdrop. They can put anything in: live scenes, moving videos, seascapes. And so what happens is, first, the sound is amazing. There's got to be 1,000 speakers. You don't see them. They're all hidden. But U2 is a trio, and I've never heard a bass sound better. Most of the time, basses get lost in mixes. Mixes are terrible at rock concerts. You can't hear the bass player. You heard the bass player really clearly. It was quite amazing. But when you're 30 rows back, fairly close, the screen goes up behind them and over you. And all of a sudden, you can't really see much. The best seats are actually in the middle. There's like 4 tiers. There must be 50,000 seats in this thing. And there's 4 different tiers that go slope back, and you're way back. So the best seats are actually up a little higher, so you can actually see the show. So the good news is the band's never sounded better. The video is amazing experience. The problem is the building's the star. The band's kind of lost. It's very tiny. The band, this gigantic thing where everything just lights up around you. So I'm not complaining. It's really a new sense of experience, but it's a little overwhelming. And when the backdrop starts moving, which happens a lot, you get a little vertigo. You go like, wow, holy shit, this is quite amazing. And it's really something to see. So it's quite something. And I thought it was great, but it's not optimal.
Seems like quite the experience. I've seen some pictures and videos, and you're really like immersed in there. Any other concerts coming up, Bob?
Going to see Dylan in the next few weeks, but yeah, it's a quite amazing business here. So let's talk a little about the markets here.
Yeah. So Bob, why don't we just start off with what's been driving stocks recently?
Well, I would have to say it's about inflation. It's about 10-year yields. And look what happened today. 10-year yields were down pre-market, markets up. When 10-year yields spike up on economic news or on a bad bond auction, we had that yesterday, we tend to see the stock market move down. And this is sort of a perfect inverse relationship. It's not perfect, but look, Monday yields were up, stocks were flattish. Tuesday yields were down, stocks were up. Wednesday yields were down, stocks were up. Thursday, yields went way up in the middle of the afternoon and stocks went down. And so what's quite amazing is seeing this relationship here. And so the key to the markets right now is what happens to interest rates. So we have to get some control over the inflation picture. Powell yesterday came out and said, well, we're moving towards 2%, but we're not sure we can get there without raising rates more, and the market moved down again on that. So what the market wants to know is the Fed's done and when they might start cutting rates, because that would help the market. Powell doesn't want to talk about cutting rates because they're still fighting inflation. It's ridiculous. But the stock market tends to think 6, 8, 9 months ahead. So they're trying to sort of second guess where the Fed's going to be 6 to 9 months from now. And Powell doesn't know himself. So it's a problem. So we're going to get the CPI numbers, Consumer Price Index, on Tuesday, and the PPI, which is the Producer Price Index, on Wednesday. This will give us more data on where inflation is going. What we want is the trend to be moving down. Okay, so it was really high in the middle of last year. It's been moving down, and the question is whether in the next few months, whether the stuff moves down enough for the Federal Reserve to be happy. And the answer is they don't know, because we don't have the data yet. So tell me where inflation's going, and I can tell you a lot about where the stock market's going to be going, because it's quite obsessed with the direction of interest rates right now.
Yeah, definitely a lot to be watching there as we head into year
end. And remember, Katie, it wants lower rates. The market wants lower rates because lower financing costs and less competition from bonds. You know, you got people sitting there with their 5% yield on one-year treasuries. They don't want to go back in the stock market. Why should they?
Right.
Lower might force more people back in the market.
Mm-hmm. Yeah, definitely something we'll be watching closely, especially over the next couple of months. Another thing we've been watching, Bob, is earnings season. So how's earnings season been going so far?
Yeah, generally the third quarter earnings season's been fine. The problem has been the comments about the fourth quarter. So there's a number of problems. Number one, some companies are seeing some demand weakening that were strong during the pandemic. So consumer staples, maybe not as much. Another problem is pricing. Companies have been aggressively raising prices, particularly consumer staples. A lot of them are reporting price resistance. That's good for consumers. I'm happy, but not good necessarily for companies. A lot of CEOs are talking about, well, it's a little more cautious environment. We kind of think the consumer's slowing down, but not much. The lower end consumer might be. There's a lot of cross currents right now. By and large, the job market is still strong. There is still a significant amount of consumer savings around from the pandemic, but it is being spent. It is being pared down. Credit card debt's going up a little bit, but not overwhelmingly. So we're kind of in the transition period. We have been waiting for this recession for more than a year. Eventually it will happen, but this is like the longest mispredicted recession in history. Last year, we were supposed to be in a recession right now, and we're not. So trust me, all these people who think they know what they're talking about don't know anything. They were all wrong last year, and they may be wrong. We may have a soft landing where there's a modest downturn, but no serious recession. That's still the most likely scenario, but it could be worse. It's really hard to figure out right now, and the stock market is reflecting a lot of that uncertainty.
So we just have, a month and a half left of 2023. So Bob, will we see stocks sell off into year end? What do you think?
Well, historically, this is a really favorable time of the year for a couple of reasons. Number one, November is this November, December. This is the two best months of the year on a historical basis. The market usually more often than not will rise from this point, from November 1st to the end of December, historically. That's not always true, but that is the trend. The second is market tends to be up a little bit more in the quarter before a presidential election as well, for various reasons. And so you have some what we call seasonal factors that are very important. What ultimately really matters, though, is the state of the economy. That will override any seasonal factors. And right now, the state of the economy is still pretty good, but there are some warning signs that are out there. And a lot depends how well we navigate this inflation story, number one. And number two, of course, we have these geopolitical events. We have the Russia-Ukraine war and, of course, the Israel-Hamas war. These are factors that impact the global economy, but the exact impact is very difficult to figure out because things can change on a day-to-day basis. So you see the uncertainty level that's out there. It's very hard to model something like what is the impact of the Israeli-Hamas war when we don't know. There are all sorts of ways it could go. Hopefully it will end soon, but we don't know, and we don't know what the large-scale impacts are. So it's a tough time for the markets now. A lot of sort of X factors out there.
So it is, as you said, a very uncertain time. But when we're looking at beginner investors, what would your advice be for someone who's just starting out investing?
Well, I would have to say the most important thing, excuse me, that I see that's out there is recognize the facts about the market and how the market, really works and how it really operates. I don't think people quite understand what's going on. The thing I keep telling people is market timing does not work. You think that you can figure out when you want to go into the market, out of the market, and you can't. The evidence is you don't know how to do that. In fact, nobody does, because nobody knows when stock prices are going to move up or down. And you have to be right going in and going out. When you say, oh, I'm going to buy Apple next week and sell it 3 weeks later, you have no idea whether that would be a good strategy, or simply buying and holding would not be a superior strategy, or just owning the S&P 500 and forgetting that you think you can be a stock picker is not going to matter. So the reason there's a problem about why the future is so unknowable, and I write about this in my book. There's several chapters about why the future is so hard to figure out in my book, Shut Up and Keep Talking. The first problem is that predictions, your thoughts on the stock market are riddled with biases that will limit the quality of your predictions. So people exhibit overconfidence. People exhibit herd behavior. People they follow other people and they think they're going to be right and they're not. People exhibit recency bias. They think that what happened in the last few weeks is going to happen in the next 2 weeks. That's not true. Nothing about what happens in the stock market in the past is necessarily predictive about the future. You could talk about probabilities. I just talked about seasonal factors. Probabilities high, but there's no guarantee at all. It could be wrong. The second problem, besides biases, is people lack information about events because the future's unpredictable. Think about a simple company, Caterpillar. You're an analyst. You're supposed to figure out what Caterpillar's earnings is next year. You think that's easy, right? And what the stock price is going to be. It's just one company. Turns out there's hundreds of variables that go into this. There's the macro, the global economy that could impact what Caterpillar does. The Chinese sales, the economy in China, the Israeli-Hamas war, the Russia-Ukraine war. Then there are the corporate executives around it. The CEO could fall ill. They could have a management change. They could make a purchase of a big company that's a disaster. They could do anything. Think about the thousands of variables that go into determining the stock price and the earnings of the company. And it turns out you really don't have complete information because you don't know what's going to happen between now and 1 year from now that's going to impact that stock. And the stock moves immediately on daily information. That you may think you have the company right until October 1st, and something happens October 2nd that's not in your model. So once you understand this, you become a lot more humble about predicting the future. What you do know is historically, long term, the stock market has tended to rise. The S&P goes up 3 out of 4 years, 3 out of 4. And remember that. So that's very, very important. I'm getting a notice on my computer here that it's going to reboot, Katie. We may get. I don't know why this just appeared on my screen here, but I think the important thing for everybody is please recognize about what your biases and how difficult it is to figure out the future. Have a long-term plan. Understand your own risk tolerance. If you can't sleep at night because 70% of your retirement fund is in stocks, then that's a problem. But I will tell you, recognize for most people that are out there, most people are going to live to 90 to 100 years old. And if you're 30 or 40 years old, that's 50 more years of investing. The S&P was down 20% last year, but that's not going to matter much in 10 years. Trust me, it's not. And it's not going to matter at all in 40 years. So I just want everyone to understand the long-term game. The stock market's not a casino. It's the opposite of a casino. In a casino, you're designed to lose money long term. In the stock market, staying in it, you have historically made money. It's the opposite of a casino. If we get cut out here, I'm sorry. I'm getting some very strange comments on my computer here about it. It's going to install some new software on me, Katie.
All good.
If anything happens there, please don't worry about anything. But the important thing here is the long-term thinking that everybody needs to maintain about this. And I know it's very difficult to think long-term when suddenly you are going to have your next week matters, or you think that you have permanent loss of money because the S&P is down 20% in the year. And the answer is it's not true. You don't. And it's only that moment. Remember, you don't actually have a 20% loss in the S&P 500 last year unless you sold. It's all on paper. So you look down and say, oh my gosh, I'm down 20% at the end of 2022. This is a catastrophe. I have to sell. but you're not down. You're actually not down until you sell and take the loss. And now you hold on. It's a year later, the market's up 14%. Mm-hmm. It's a completely different situation. So I feel very passionate about this, that people don't know how to look at these things terribly rationally. Now, yes, if you needed that money this year, being down 20% may have been a very serious matter, and you maybe should have had less money in the stock market. But if you were a long-term investor, trust me, it's not going to matter that much. That's the key here.
Yeah, no, I think that's really helpful advice for everyone, Bob. Just keep that long-term perspective, and even the experts can't predict the future. So there's a lot of uncertainty in the stock market. So just to wrap up here, Bob, you recently celebrated 33 years at CNBC. So congratulations.
Thank you.
It's been, a great, run with CNBC so far. So what have been some of your most memorable moments?
Well, they did a nice little tribute to me, and what they did was they showed a lot of old pictures of me from the early 1990s, and it's funny to see yourself from 30 years ago.
Yeah. Few people have their fashion, documented the way that you did, Bob.
Yes. Yes, I had brown hair at once, and now I dye my hair gray because it makes me look more important. But it's funny to see yourself in brown suits. Earth tones, greens and browns, were very popular in the mid 1990s. And so there's a lot of pictures of me with these green suits, big wide ties with splashy colors, double-breasted. There's a fashion that has not come back in a long time. I doubt it will, but it's kind of funny to see yourself, and you can tell what year it is. It's like looking at the Beatles haircuts. You can tell. Excuse me. You can tell what year it is just by looking at the Beatles haircuts. I can always tell what year it is just by looking at the suits that I'm wearing. But what's amazing is just thinking back about what mattered and what I saw when I was there. I would say the most important thing I saw was electronic trading, the birth of electronic trading and decimalization. People, when I got there in the mid 90s, people were still trading on the floor by open outcry, yelling back and forth. I got 100,000 shares of Pfizer to buy. Who will take it off my hands? It's all electronic now. Markets are arguably more efficient. I think they are. I think they certainly move faster. The other thing I saw was the growth of passive investing in ETFs. I became a Jack Bogle disciple. Jack Bogle founded Vanguard in 1974, as I recall. Meeting him changed my life. Bogle passionately believed that most people can't beat the market, and the best thing to do is stay with the market. So everything I just told you largely comes from Bogle and my period hanging out with Bogle. So that would be number two, what I saw, passive investing in ETFs. And then I would say behavioral finance. Behavioral finance purports to show how people really are and how they really act, not how they're supposed to act. So everybody used to think people acted rationally economically. They bought low and sold high. They don't. People don't do that. People are irrational. And a very large component of the stock market appears to be generated by a somewhat irrational behavior. There's a discussion in the book about this, but this goes back to understanding biases, which I talked about earlier. And when you start studying this and see what human beings are really like, they are not perfectly rational as creatures. And so what is the implication of that in the stock market? What the implication is, you get a lot more volatility in the stock market than you would expect if everyone was perfectly rational, if everyone looked just at the fundamentals of companies that are out there and thought, okay, well, here's what we think is going on, here's our estimates, and they don't act that rational. They tend to work on extremes of exuberance and depression more often, and so you have to factor that into the stock market. The market is very efficient. It incorporates everybody's feelings at any one moment. But there's a lot of people, different people with a lot of different feelings. There are some people that are coming into the market for a day. Literally, they're trading at 9:30 and they're getting out at 3:30. That's a very different kind of investor than somebody who is buying for their mutual fund, for their 401k, and they're going to hold that fund for 30 years. Those are two completely different kinds of investors. And yet, on any given day, they're present in the stock market. So that short-term investor is more likely to be subject to various biases than that longer-term person, although he may have it too. So once you understand this stew, you stop trying to second guess the market all the time. You become a little more comfortable with uncertainty, and you have some core beliefs. As I said, my core beliefs, long-term, the stock market is the best investment out there. Long-term, not necessarily year to year. I also own the home I own. I also own bonds. So you don't put all your eggs in one basket, but long-term, the stock market tends to be the best investment, largely because it's the highest risk investment that you got. By the way, you asked me about a favorite moment. And this is in the book, I talk about celebrities. I met, Robert Downey Jr. and Aretha Franklin. One day, Jimmy Page came on the floor. Jimmy Page is the lead guitar player for Led Zeppelin. This was 2005. He came with Edgar Bronfman because they were floating Warner Music Group, as I recall, an IPO, big famous music group. And Edgar Bronfman came with Jimmy Page. Well, we were so excited, all of us, because I'm an old rock guy. And all the guys on the floor were old rock guys. And so people came and brought old Led Zeppelin vinyl for Jimmy Page to sign. So he opens, and instead of ringing the opening bell, you push the button, and Jimmy Page starts playing Whole Lotta Love through the sound system. Like, and you can still see this. Type in Jimmy Page NYSE. You can still see this. And it was just a fantastic moment. It was loud, and people were screaming. I was screaming. I'm down below cheering, and we're waiting. He stops, and Bronfman's, standing next to him, ringing the bell. And we're waiting for him to come down the stairs, Edgar and Jimmy, so he can meet all of us and we can say, hello, I can get an interview with Jimmy Page. I'm excited. And when you come out of the podium, when you're ringing the bell, you come down the stairs and you can go left or right. If you go right, go down the stairs, you go out on the Broad Street, and you can have a car waiting for you. In other words, if you go left, you come right onto the floor. So we're standing there. I'm standing there with my microphone, Jimmy, and it's 100 guys behind me with worn Led Zeppelin vinyl covers. And Edgar Bronfman comes out, and I said, hello, Edgar. I know Edgar. And I said, where's Jimmy? And he said, he's not coming. I said, what? You're kidding? He said, no. Jimmy turned right, went up. And we've known Jimmy Page has issues dealing with people in close circumstances. I don't know what the technical term would be, but it makes him a little nervous. So he didn't come. We were all a little disappointed, but that was a great moment. I'd have to say, just meeting dozens, and I mention a lot of them in the book, of kings, queens, politicians. Boy, what a great job. When people ask me, why have you stayed at the New York Stock Exchange for 27 years? I said, what would you do to meet all of your heroes? What would you do to meet anyone you'd ever wanted to meet? Any famous person? Think of it. And I've met all of them. I go out, the bell rings twice a day, and you can't imagine all the people who are there. And I just walk up and say hello. Sometimes I don't, but most of the time I'll say hello. You chat. What's it worth spending 5 minutes with the CEO of Chevron? It doesn't matter even if you interview them. Even just standing next to them saying, how's business? What do you think? Blah, blah. It's amazing the kind of insights that you get. So it's a great job. I said it's a great privilege to work with a wonderful company, CNBC and Comcast, and it's a great privilege to be on the floor of the New York Stock Exchange. I don't work for the NYSE, but I've been there a long, long time. I'm like part of the wallpaper down there, and it's one of the reasons I stay is just that ability to meet famous people all the time.
Yeah, well, you definitely have some great stories, and you definitely know the stock exchange better than most people, Bob. I know you're a good tour guide when people come to visit. So congratulations again, over 30 years with CNBC. So huge accomplishment. And yeah, thank you again for answering all of our questions every week. Thank you to everyone who submitted questions. We always love seeing them. And we'll talk again soon.
Thank you, Katie. Thanks, guys. Thanks, everybody, for the questions. Always astute. Have a good week.
Thanks, Bob.